All right. Last week, the RBI tightened the loan provisioning norms for banks and NBFCs to check the rapid surge in unsecured retail loans. Of course, it's a big positive, but the RBI has gone ahead and raised the risk weightage from 100% to 125%. Now, there is an impact that this would have. So to assess that, we speak to Equitas Small Finance Bank, which has, I think, 3% of their portfolio is unsecured. P.N. Vasudevan, the Managing Director and Chief Executive Officer at Equitas Small Finance Bank, joins us now. Mr. Vasudevan, greetings of the season to you. Thank you for being with us on the channel. If you can just start by clarifying, right? You have unsecured portfolio. How much is it at the moment? Is it to individuals? And what is the impact that the RBI norms would have on your capital adequacy ratio?
Yeah, hi, good morning. We have 20% of our book, which is microfinance, which is unsecured. But microfinance is not covered by this new guidelines, which has come from RBI last week. So there's no change in risk weightage as far as the microfinance book is concerned. Outside of that microfinance, so we have no other unsecured book. All of the rest of the book is secured book. The balance 82% is secured book. But what happens is, even though RBI, the intent of RBI was to curb the unsecured personal loan growth, but as per the technical definition of RBI personal loan definition, it includes loans which are given against security, but the end use is not a business use. Even that loan gets covered. So in our case, in Equitas case, we have a certain part of our loans which are given to salaried employees as a loan, but that loan is secured against property. It's a LAP loan actually, but that gets covered under the technical definition of personal loan of RBI. And so there is a risk weightage that we have to increase on that portion of the book. And because of that, there will be an impact of approximately around 60 basis points on our capital adequacy. Of course, we have a high capital adequacy, so that is not an issue by itself. But outside of that, we don't have any unsecured personal loans at all in the system.
Okay, that's a very important clarification. So you're saying that 20% of your book is microfinance, which is unsecured, but microfinance is not covered under the norms. The LAP loans, which is loan against property, the risk weightage goes up over there. And that will have a 60 basis points. So the overall impact for you on your capital adequacy ratio will be 60 basis points. Got that. But you also have exposure to NBFCs, right? Will the RBI's increase in risk weights impact your capital adequacy overall because of the exposure to NBFC? And can you just explain to us what the rationale behind this is?
Yeah, so see that we do have some exposure to NBFCs, and any exposure to NBFCs which are A rated or AA rated or AAA rated will have a capital adequacy impact. Any exposure to NBFCs which are BBB rated, because they are already at 100%, so there's no risk weightage increase on that. In our case, we do have some exposure to NBFCs which are A and AA rated, but our overall exposure to NBFCs is about 3.5% of the book. And this 60 basis points impact I mentioned includes the impact on the NBFC capital adequacy increase. And from a logic perspective, from an RBI guideline logic perspective, one would say that, there has been a lot of NBFCs who have been growing strongly, both on the secured and unsecured book. And the reliance on bank loans has been increasing. It's almost now 55% of NBFC loans are from the banking sector. And so there is a need from a sectoral perspective to kind of see how to reduce that exposure of the bank to the NBFC so that the risk from the NBFC doesn't impact the banking sector. Maybe I'm just assuming that could be the logic behind the RBI norms. But yes, in our case, including that is the impact of that 60 basis point that I referred.
Mr. Vasudevan, good morning. Prashant here. Apart from this, would you, we've spoken with other financial institutions as well post this move. The RBI governor gave a speech recently kind of stressing upon the actions which came out last week on Thursday. There is a signaling effect in all of this as well, right? Which is to say that go slow, be cautious, don't get over exuberant, and beyond the actual quantitative impact, do you think this will have a moderating influence across the board?
Yeah, see, what happens is, today we are actually in a very benign credit cycle, right? Across the sector, the credit costs are at one of the lowest in the last few years that we have seen. And normally, what happens? I mean, I have been in the lending space now for about nearly 40 years of my life, and over so many years, I have seen lots of ups and downs in the industry in terms of GDP growth and banks and NBFCs doing well or not doing well. And what has always been happening is that when the markets are very good and the credit cost is low and GDP is somewhat strong, then the repayments from customers are generally very high. The ability to collect money from the customers is very high because they are all making money, and so they'll tend to pay you back. So even if you are relaxing your credit norms, even if you are kind of opening the funnel to accept more customers which you would normally not accept, they will still pay well because of the environment that we are living in. And that's a time when lenders tend to become a little relaxed, and they take their eye off the ball, and the credit norms tend to get diluted, and then you want to grow, you want to outgrow somebody else, so you start lending at a higher LTV, and that becomes a risk. So at some point, it looks like everything is right and nice, but there's always going to be a change in the environment and situation. And when that happens, all the excess credit filter that you have removed over this good period is going to come back and bite you just down the line. So I think this caution from RBI is really from that perspective that while things seem to be good today, but if you are not going to be careful, the downturn can be just a little while away. And that I think is a caution that all of us are taking, and we'll all be reviewing. I mean, even in Equitas, we are reviewing our own growth plans and our own product portfolios to ensure that we are not reducing the credit filters just to ensure that we are, outbeating someone else or the market.
That's very well put, and absolutely agree with you that the RBI is kind of looking ahead at the next cycle, which is inevitable. It's a question of when, not if. But as you ended the last answer by saying you were also reviewing internally what you would like, if you like to change anything in terms of focus and areas of focus. Could you give us some indication? What would you like to do directionally, if not firmed it up, but directionally in terms of the thinking internally?
See, in our case, for example, in the first half of this year, we had a gross advances growth of around 36% and a net advances growth of around 32%. So we are now internally debating what should be the growth rate for the second half of the year, and know how much do we moderate and how should we moderate, and which product we should tighten the credit filters and etc. As of now, of course, our GNPs are very good. It's less than our pre-COVID level. Pre-COVID used to be 2.5%. We are now slightly lower than that. Our net NPA is lower than 1%, which we have the first time we have touched less than 1% NNPA. So things are going good, but we are taking all the caution from RBI very seriously, and we'll be debating internally as well as within our board, and to see what should be our second half strategy in terms of growth, and not just second half, but also going forward. How much should we moderate? Which product we should be a little bit more careful, and things like that. So this is an exercise that we are definitely very seriously involved in.
All right, Mr. Vasudevan, I love the way you put it. 40 years of experience, and that showed, right? You keep an eye on the ball, need to firm up plans. But give us a couple of numbers then. Your NIM saw some kind of pressure, in the past quarter. It came down to around 8.4, 8.5% approximately. What's the outlook in terms of NIMs from year on, point number one? And also in the first half of the year, as you said, you grew by around 30% plus, gross as well as net advances. So for the year on an average, what could that be? Give us a rough range at least on both these two numbers.
Yeah, on the NIMs, we are going through our the tight cycle of NIMs, because we have about 85% of our book is fixed rate loan book. Given that, when the interest cost goes up, your NIM is going to have the maximum impact. And I think we have gone through most of that pain in the last 3 quarters or so. We have actually gone through the most of that pain. And so as we guided earlier, for the full year, we expect our average NIM for the full year to be around 8.5 compared to about 9% of the previous year's average. So you are really seeing about a 0.5% drop on NIMs for the full year. I'm not talking of half, I'm talking the full year. And in terms of going forward, assuming that the interest rate remains either at the current level or even marginally comes down, given that we are at 85% fixed rate loan book, that is when we see that the benefit is likely to come over the next 3 to 4 quarters, because we have been increasing our lending rate over the last 2 quarters, and that benefit is still not fully realized on the book because of the older advances. So the benefit of that interest rate will come over the next 2 to 3 quarters. And if our interest cost kind of stops growing further, then the benefit of the fixed rate loan book will be felt maybe in the next financial year. And as far as the growth is concerned, as I mentioned, first half we had a 37% growth in gross advance and 32% in net advances. And we expect that for the second half and for the full year, we should have a gross advance growth of maybe around just around the 30% level, and a net advance which will be lower than 30%. That's what we expect. We're still working on some of these finer points, but definitely we do look to moderate the growth in the second half a little bit to ensure that we don't become exuberant and do anything which is silly.
But for the system as a whole, right, for the industry as a whole, the fact that RBI has raised these provision norms across the board, do you think it could slow down loan growth for the industry?
Yeah, definitely. I think the personal loans, the unsecured personal loans, especially the small ticket loans, which are 5, 10,000, 20,000, under 50,000 loans, that has grown approximately about 40% in the first half. And that the expectation is that that might come down to anywhere around 25 to 30%. So that's going to be a steep, 20, 25, 30% drop in terms of the growth on the unsecured personal loan side, which should, in a way, moderate the overall sectoral growth for the banking and NBFC industry. As far as the secured book is concerned, right now there is no concern either from the industry or from the regulator. But as we said earlier, we just need to keep our eyes open all the time. But on the unsecured, definitely, I think we should see a sectoral decline.
And I didn't get the net interest margins. You said around 8%, is it? What is the kind of ballpark range that you're looking at for the full year?
I mentioned that our exit NIMs could be about 8 by fourth quarter of this year, and then overall NIM for the year on an average basis for the full year could be around the 8.5%.
Okay, all right. We will leave it at that, Mr. Vasudevan. Thanks a lot for joining in and giving us your view on the business and the way forward. That's Equitas Small Finance Bank. Just wanted to mention a few stocks. There's a lot of traction, by the way, happening in the market, so don't